I have a confession to make. I made over $1 million in side income on the internet in 2021, and I will not pay a dollar in income tax. I'm about to tell you about depreciation, mainly bonus depreciation. This is the way, this is the number one tax loophole that real estate investors utilize. And I'm going to tell you how you can utilize it. We all know the story of a couple years ago. You know who paid $750 in taxes, and everybody thought that was ridiculous because this person's a billionaire. They make all kinds of money. Listen, I don't write the rules. I don't make the rules. I don't have an opinion on whether these rules are right or wrong. I'm just going to tell you that I utilize them. I utilize real estate depreciation, and it helps me from a tax standpoint. The government, I'm just going to tell you a fact, the government at one point believed in incentivizing ownership of land and buildings. Why? They incentivize from the tax perspective the ownership of buildings because they know that humans spend over 95% of their days and their time in buildings. So if we are going to have a strong infrastructure, if we're going to have strong hospitals, self-storage facilities, apartment buildings, medical offices, multifamily rental complexes, we need to incentivize it from a tax perspective because those things are key to our economy. That's what somebody said at one point. And so we had a bonus depreciation and depreciation inserted into the tax code. What does this mean? How does it work? So let's talk about a $1 million self-storage facility. Just an example, $1 million piece of real estate. That $1 million piece of real estate, you get to deduct the cost of that original asset against your income over 39 years. 39 years. So it's about 2.5% per year. So if you spend $1 million on a building, and again, you cannot depreciate land because land doesn't get less valuable in the eyes of the government. A building does get less valuable. You have to maintain it. You have to do all these things to, it wears out. It has a useful life. And a commercial building is 39 years. A residential building is shorter, 27 years. You can't depreciate the land, but so let's say maybe $1.3 million you paid on an acquisition of a self-storage facility, but $1 million of it was the building itself. And the building itself has a lifespan of 39 and a half years. You get to depreciate that over time every year, 2.5%. Let's say you spend $1 million on this thing, and let's say it was fully depreciable, just as an example. And let's say you use some debt. Put $300,000 down and $700,000 of it came from a bank. Now, even though $700,000 of it came from a bank, you still own it. You get to fully depreciate it. That's one of the massive powers of leverage. So you're looking at 2.5% of not only the $300K, that's only $7,500 a year, $7,500 a year. You get that 2.5% of the full $1 million, which is $25,000. So $25,000 deductible every year for 39 years on a $1 million purchase. That's pretty awesome. But this is where bonus depreciation comes into play. Bonus depreciation is a code that, hey, look, not everything on this building, not everything on this property has a 39-year time lifespan. Some of it has a much shorter time span. Some of it is only 15 years or 7 years or 5 years. For example, the roads and sidewalks, the driveways and sidewalks and landscaping and land improvements, maybe those are only 15 years or 10 years. Then you have the windows. Then you have the HVAC system. Then you have the latches. Then you have the partitions inside the units. Then you have the roof. Then you have all these different things with all these different time horizons, the lifespans. What we do is we pay somebody, and I'll recommend somebody. Basically, you have somebody come through who's an engineer or a cost segregation specialist, and they bring in some data into this thing and say, okay, look, we've spent $1 million on this building, but $200,000 of it was the land, and the other $800,000 of it was the building. But we're going to further segregate it down to these different areas with different lifespans. Maybe we have the windows. That's one area. Maybe that's $20,000. Maybe we have the doors and sidewalks and landscaping and parking areas. We have all these different areas that you break it down into different things. Wes Mabry is my cost seg guy. 1245consulting.com. 1245consulting.com. He lives in Houston. He flies everywhere. He's extremely affordable. We're talking $3,000 to $5,000 per property, maybe a little more for big properties. To get this cost segregation study done, they send you a report and they say, okay, look, here is the lifespan for all these different buildings. Now let's aggressively depreciate it. And the code in this bonus depreciation, which was scheduled to phase out, Obama had this scheduled to phase out in his tax plan. By 2023, it was no longer going to exist. But during the CARES Act, the tax cut plan of 2017 by Trump, that's when cost segregation was brought back in and extended and made basically fully depreciable of anything under a 15-year time span. So if, say, the landscaping and the doors and the roof of your building have an under 15-year time span, useful life, then we get to depreciate all of that in the very first year of ownership. I'm going to say that again. This massive chunk, 20 to 30% generally of the cost of the building, is on a shorter than 15-year time span and all of or useful life, and all of that depreciation can be used in the very first year. That's called bonus depreciation. It's just a little carrot in the tax code that still exists. So what you can have is a huge bonus depreciation tax loss year one. I'll give you an example here. We bought 32 self-storage facilities this year. We spent over $50 million on those self-storage facilities. Over $15 million of that cost is bonus depreciation year one. We got $15 million of bonus depreciation year one. That's about 30% of the overall cost of all of our acquisitions. 15%, 30% of all of the cost of all of our acquisitions was under 15-year life cycle and depreciable in the very first year. So massive, massive tax losses for me and my LPs in bulk storage. And what this means is, first of all, the income is separated a couple different ways. Income is all different. Not all income is treated the same way. If you're a passive investor in a real estate deal, well, let's say you're doing real estate investing on the side. Those are called passive gains and passive losses. Passive income and passive loss. Now, active income is whatever you do full time. That is your W-2 job. Maybe it's my online income. Maybe it's money that I'm making from my efforts and my work. Passive and active income. Unless you are a real estate professional, which is a classification in the tax code, you have to classify as a real estate pro, which I think means more than 700 hours a year spent on real estate related activities. That makes you a real estate professional. I'm a real estate professional, obviously, because I run a real estate private equity firm. I talk and think and work on real estate basically all day. Since I'm a real estate professional, I can offset active income with these passive losses. Basically, this real estate loss, these depreciation losses every year are active for me, and they offset my active income. So when my portion of those losses is $2 or $3 million, and I make $1.5 million in income, I have a carry forward loss. Even though I make $1.5 million in cash in a year, I have $2 to $3 million of active passive loss through real estate losses, through depreciation, basically wipes away all of my tax burden. Now, there's a lot of nuance to this. I cannot cover every aspect of this part of the tax code in this episode. I want you to talk to your CPA, get a good CPA. And there is something called recapture, meaning if I sell this stuff later on, if I sell these assets, my basis is now lower. Every time I depreciate these assets, my basis drops, and I have to pay income tax or capital gains on the difference between my basis and the sale price. So you end up paying those taxes eventually if you sell an asset. But if you're in my situation and you don't sell assets, you just buy assets every year by the factor of $50 million worth of real estate a year, you can have extremely powerful tax losses, even though you're making a lot of money, and you can virtually pay no tax. Now, another part of this, we have carry forward losses. So let's say I have a friend who buys short-term rentals. He has an active business. He runs a major company, makes a lot of money. So that's all his active income. And then he has this side bucket where he invests passively in real estate. And those losses, while he can't offset his major income, which is a big problem, he can't offset his major income unless his wife is a real estate professional. If one person in a marriage is a real estate professional, then you can use real estate pass-through losses to offset your active income. And again, I'm not a CPA. I'm not claiming to be a CPA. This is not tax advice. I'm just telling you how I understand the tax code and how I utilize it personally. If your wife or your husband is a real estate professional, then you can offset your group active income with these losses. His wife is not. It's a little bit of a blurry line. She was thinking about becoming a realtor, spending 700 hours a year on real estate related activities. That would technically make her real estate pro. Wasn't worth the risk for him, but he's in the short-term rental space, which very often it's 20 to 25% cash on cash yield. So you have a lot of taxable income coming in the short-term rental space. And if he buys a property, gets a cost segregation study done, he can carry forward those losses into eternity until they run out. So if he buys a $1 million short-term rental portfolio, gets $200,000 of bonus depreciation, only makes $100,000 that year in profit, he wiped out all the profit from his real estate income with those bonus depreciation, carried a loss of $50,000 into the next year or 100, and then it can offset income in the following year. So these things can carry forward. So I highly recommend for you to take advantage of bonus depreciation. If you have not got a cost seg study done on any building that you bought, and again, I cost seg everything. I bought a home, a short-term rental investment in an area with some of our self-storage facilities in my wife's hometown. I put it on Airbnb. It's an income-producing property for me. It's a $380,000 home that I went and got a cost segregation study done on. It's a $3,000 study that allowed me to write off and pass through a $39,000 year one bonus depreciation loss to offset my income. I saved more in taxes year one than I paid for the cost segregation study. And I get to carry those losses forward. So again, Wes Mabry, it is 1245consulting.com. Highly recommend him as a cost segregation specialist, but there's many cost segregations. If you Google cost segregation company in your town, you will find somebody who can do one of these studies for you. Wes travels all over the country. He did, again, more than 30 facilities for me all over the country. But yeah, this is a extremely powerful concept that you need to do more research on. You need to fully understand. You need to talk to your CPA about. And if your CPA, God forbid, says you don't want to do a bonus depreciation because then you just have recapture later, you need to put them in your place and fire that CPA. Fire that CPA, because a dollar saved now from taxes is much, much more valuable than a dollar saved later in taxes, because we are real estate entrepreneurs. We know how to invest our money. We know how to compound that money. So save every dollar you can in taxes now and get your cost segregation studies done. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to The Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group, to get some momentum, get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.